Welcome to RiskWatch Plus. I'm Dennis Agel.
I'm Ken Agel. Thanks for joining us today.
So each week, our editors at Risk Inbox scan dozens of industry websites looking for hot topics, and we curate that down to the hottest of topics, and we put them here on this site, Risk Inbox Plus. Today, we've identified 3 items that we want to share with you that are hot topics in particular. The Federal Reserve has released its second issue in 2020 of Consumer Compliance Outlook. So early in the COVID-19 crisis, the Federal Reserve issued guidance to help customers and communities through the crisis. They released Supervision and Regulation Letter 20-4 and Consumer Affairs Letter 20-3, which affirmed some previous guidance from the Fed that it released in 2013, but it applied it to COVID-19. So, in effect, this publication is offering guidance on the guidance, which affirmed previous guidance. So, nevertheless, it's useful information, including how the agency would look favorably upon an institution's CRA efforts if the institution did such things as waive ATM fees during the emergency, waive overdraft fees, increase ATM daily cash withdrawal limits, ease restrictions on cashing out-of-state and non-customer checks. So, Ken, it's not a carte blanche to engage in risky safety and soundness efforts, but how do you see this guidance from the Fed?
Yeah, so like we talked about last week in our last presentation, Compliance Spotlight on risk to disasters, obviously institutions have to be prepared for it, but they also have to be able to manage the consumer side of it. So this particular document is trying to encourage elements that would help consumers/members to respond to the event, but at the same time, you got to take into account the safety and soundness risk factors, so a balance is always warranted. Typically, that's what the government is always looking for from financial institutions, that balance.
So this Consumer Compliance Outlook issue that we usually comb over very carefully because it's responding to what the agency is seeing as issues in the field, is completely devoted to disaster and emergency response, so worth taking a look at. Let's move on to the next hot topic. This one has to do with CRA. It turns out, following the House's measure a couple of weeks ago to seek to overturn the OCC's revision to CRA, the measure would also have to pass the Senate and survive a veto from the White House, which seems unlikely, but still it registers the House Democrats' displeasure with the way the OCC released its CRA revision. So now here we've got consumer advocacy groups who are suing the OCC, claiming that it unlawfully is gutting the CRA, that it rushed the new rule out under cover of the pandemic, that the new rule would actually dilute bank investment in low and moderate income communities. So here's another group piling on against the OCC CRA reform measures. Thoughts on that?
Apparently, nobody seems to be happy with the OCC. I do think, however, when you take a look at the past historical efforts as it relates to ratings and the fact that we're going to focus on that today in some measure, obviously, when you have groups that are not happy with something, it probably means they want to satisfy their needs, and that means that you're, again, trying to seek that balance. Never easy in the regulatory world. I think the OCC gave it a fair shot, a good faith effort, but apparently it's not quite ringing true, at least for the various community groups out there.
But wait, it gets worse. So completing the trifecta of entities unhappy with the OCC CRA rule revision, not even everybody in the banking industry is happy about this. Here's an article that came from the ABA addressing the modernization effort of the OCC, and their concerns are that the rule change really only impacts a small number of banks. It's limited to banks that have assets of more than 2.5 billion, and that's about 120 OCC banks, which is a small percentage of the overall banking community. And that the other concern they raise is that the specific metrics the OCC proposes to assess are still outstanding. So they're going to be releasing those in some guidance that's to come this summer. But here's the main concern they had. In moving forward on its own with the CRA rule revisions, it seems unlikely to withstand the test of time and will likely be subjected to continual revisions based on the political whims of the day. So Ken, the banking industry isn't thrilled with the new CRA, but for different reasons than the consumer advocacy groups and the House Democrats.
Yeah, I think they bring a very important point that you want to have all of the FFIEC members that are particularly impacted by CRA jointly agreeing on the process. So they didn't get that, of course, with the FRB completely out, the FDIC kind of in, kind of out, but nonetheless, having that unified front, working with community groups, seems like the pathway to success right now. I don't think anybody would say that CRA is functioning as it was intended. I also don't think anybody who's reasonably looking at the regulation would say that it's not doing something. But at the same time, we want this important legislation, especially given the social, economic events of today, to work for all groups. That's not easy to accomplish, but it seems like it's going to take a little more joint effort for that to happen.
And that's a good lead into our regulatory compliance spotlight for this week, which we'll get to right after this message. Welcome back. Today our compliance spotlight is a fair lending institutional performance studies, and we're going to focus on the Chicago MSA. So Ken, you've been doing a pretty deep dive into what the data are showing for this particular MSA. What are you finding?
Yeah, so Chicago, of course, being one of the largest metropolitan areas in the nation, is going to be a very complicated but important study for us. So when we take a look at the 2019 HMDA data, of course, we are receiving even more information because it builds on the 2018 information. We're still missing some of the critical elements that we really want, namely as it relates to credit scores, but we have a tremendous amount of information at our fingertips available for us to utilize. So 2019 HMDA data included 15.1 million entries by 5,508 reporters among the 384 MSAs. Now that's a little bit lower than 2018, especially when it comes to the reporters. So again, we're seeing a constriction of reporters, largely based on the size requirements, some of the nuances created out of HMDA, but we still have an awful lot of reporters. Now we take a look at the Chicago, Naperville, Elgin, Illinois, Indiana, Wisconsin MSA that we're going to call the Chicago MSA because it's quite a mouthful to say. I think we'd all agree. So there were 342,000 or so entries among 907 reporters. So think about that. Almost 1 in 5 reporters have at least one entry in Chicago. It is a powerful and dominant market. We're going to focus on insured financial institutions. Not only that, we're going to sub-focus that as it relates to approvals and declines, action codes 1 and 3, and we're going to sub that down to conventional first liens. Similar to what we almost always focus on in flips, because remember, we're just kind of giving a slice of the process. So before we get into flips, let's get a little bit on the MSA itself, Chicago. Now, here you can see almost 10 million in population. So yes, this is a dominant MSA. Not only that, you're taking a look at a large regional area at a fairly dense area, 1,320 people per square mile. Now, the next part about that is when you take a look at the demographics, of course, you would expect to see a median age, which is typical of the United States. But now race and ethnicity, always something of significance. with 52% of the population, based on the 2018 updated information, being white and 16% black. We also have an ethnicity of 22% Hispanic, so a fairly diversified, followed by Asian at 7%. So we've got a lot of different demographics within this particular MSA, all of it being of interest to us when it gets into flips. Now we take a look at the income levels and the poverty levels. This is a higher poverty level than what you would expect as it relates to the United States. So 11.2% of persons are below the poverty line. Now think about that. That means that individuals not having a living wage represents 1 in 10 individuals plus. All right, now let's take a look at the actual housing statistics here. When we take a look at occupied versus vacant, 92% of housing is occupied, but ownership of that is far lower. So we're talking about only 65% of units are owner occupied. Not only that, when we take a look at the type of structures, we're looking at a fairly logical but a very broad-based income level. The median value of owner-occupied housing units is $247,000. Now, the reason why these factors become important, not necessarily for flips, although they do have an impact, but when you get into the deeper dive for an institution, when you look at the actual performance of an institution on its own merit, you really want to get into these elements because they can have a material impact. Now, you remember from our last flips exercise on Minneapolis where we took a look at the dramatic spike. We see that as well in these slides, but we also see the beginning of a recovery. You can look at the upper right and you'll see that the employment numbers are actually spiking back up, but obviously not to the level that they were before. And you can start to see a decline in the unemployment in the lower left. So that is a material factor, especially going forward. Does it have an impact on HMDA for 2020? Absolutely. What will we see? We don't know, but my guess is we're going to see some dramatic changes as it relates to purchases and potential refinances. We remember from the 2008 that the refinance market, as it related to modifications and the like, because of the dramatic changes in the economy back then, we may have similar but different impacting events as it relates to 2020 and 2021. All right, let's take a look now at our flips. Conventional first lien. When we take a look at this, we know that from the original number of entries that we talked about, we've reduced that fairly significantly down to around 85,767. Of those, we're talking about around 68,000 in approvals and about 18,000 in declines, about a 4-to-1 ratio. Not only that, we're also looking now at fewer number of institutions, 593 unique LEIs that were insured. Now, of course, we're not talking about a few institutions, and we had to cut it down, but we didn't want to leave too many of the larger players out, so we took the top 20. Makes for a little bit of a challenging graph, but I think it has value. The top 20, we had, of course, what you would expect, the big players, the JP Morgan Chases, the US banks, the Wells Fargo, the Bank of America, but we also got into the super regionals, and we got into the more localized institutions, the First Midwest, the Barringtons, the Huntington National Bank, and the list went on. Our goal in flips is not necessarily to just look at only these 20, but because of limitations, we have to cut it off at some point. So that's where we are as it relates to today's presentation. Now, the first slide we want to focus on is the approval to decline ratio. Here we're taking a look at Action Code 1 and comparing it to Action Code 3. If you look at the bottom, you'll notice that 77% of the top 20 had an approval ratio, 78 or so, and 23 or so percent had a decline ratio. Now, one thing you could quickly see is who was above and who was below. These are ranked generally in order as it related to Action Code 1. So CIBC Bank at the very top had a 97.2% approval ratio as opposed to 3%. When we're really talking about approvals and declines, it just sets us up for the next analysis piece. Does it mean it's good or bad? Not really, but it is an indicator. So we would expect, for example, CIBC's marketing efforts might be directed towards a certain market. Perhaps that market is already well qualified. That could have impact on CRA. That might be the kind of thing that floats into other areas, other regulations. Look at the bottom, BMO Harris Bank, now with a 53% approval ratio as opposed to a 47% decline ratio, almost even. So your chances of approving might mean that you have to go through more difficult underwriting processes. That being the case, you want to dive further. And that's just what we're going to do. The benefit of today's HMDA is it gives us more powerful insights. Now it has debt to income, loan to value, interest rate. It gives us the stated minority population, so we don't have to work as hard to get that. It has property value, loan term, points and fees, and so much more. It truly is a powerful and valuable asset in the fair lending world. The thing about that is utilizing that information, we can really isolate down. So if we, in this particular case, can take a look at eliminating all other entries that are not single-family properties. We can eliminate everything that's not for purchase. We can focus on closed-end, non-business purpose, owner-occupied, single housing unit, and a loan term of 360 months, as well as an amortizing debt. These particular elements allow us to really isolate down to a consistent type of group so that we're not necessarily comparing apples with oranges, but we're actually looking at fairly homogeneous types of loans. Now, the other thing that we can do is we can take the underwriting factors and we're able to utilize those in order to come up with some type of scoring. For us, we call it the Advisic score, but that particular score allows us to focus on loan to value with the lowest percentage assigned to the lowest risk category and debt to income with the lowest ratios, again, assigned to the lowest risk category. Combine those two factors and you can come up with a score, similar to like a FICO. Now, of course, it's missing the credit score, which would be very valuable. And we're not trying to say that this particular Advisic score is the end-all be-all, but we do believe it has predictive elements to it, and that becomes important. Lastly, we can assign the minority census tracts based on the tract with the population of minorities at 50% and above, rounded. So you've got a lot that are right close, but we want to utilize that demarcation point. You can get more sophisticated in your analysis, but starting at this point makes a lot of sense. All right, so what are we seeing? Now we go back to that approval to decline ratio, and we know that it requires us to gain additional insights. The surface doesn't always mean an issue. So look at the top, look at the bottom, and you have to go a little bit further. Let's go further. Now when we take a look at the approval to decline ratio, we can add the high minority census tract compared to the low minority census tract. So now we can focus on those institutions with a very high ratio as it relates to those high minority census tracts and compare them to those approval ratios in low minority census tracts. So here, for example, you see that Busey Bank had a 95.4% approval ratio, but not only that, it had a 100% approval ratio in high minority census tracts. Rather impressive, wouldn't you say?
Yeah, on its face it looks like anyone in a high minority census tract that applied got approved.
Yeah, and when we take a look at that, of course we want to applaud. We want to say that's fantastic. But it's not enough to simply stop at that point. Even our institutions that are down lower, all of them, I think we would all agree, fared fairly well, all the way down to Huntington National Bank at 76% compared to 84%. But every institution in this particular group had a fairly high and fairly consistent high minority to low minority census tract approval ratio. Let's take a look at the lowest. Now, when we take a look at this particular group, we're looking at all the way down from, at the bottom would be the next, and the top would be the lowest. First American Bank, here a 29% approval ratio in high minority census tracts. But you'll also notice what was their low minority census tract approval ratio.
That looks to be about 45%?
Yeah, 45, 46%.
46%.
Now that gap distance between the two is something that institutions want to take a look at. When the two don't match up, you have a potential for additional analysis. The great thing between of now, 2019, and say 2017, is we can look at that analysis in greater depth. So when we take a look at the percentage differences here, and we look at the First American Bank and the BMO Harris Bank, we know that, for example, BMO Harris Bank, we probably expected it to be fairly low because remember, they were at the top as it related to approvals anyway. But then we also want to focus on, does it make sense relative to underwriting? And that's where we want to head after we take a look at our next category, which is a secondary factor. All right, when we take a look at minorities versus non-minorities, we have to go through another exercise. If you've taken a look at the HMDA 2019 or 2018 data, you'll notice that it has a derived minority, derived ethnicity for each individual, each entry. The challenge with that is it has a tremendous amount of variables. So organizations have to go through and assign codes, which is what we've done. So we took a look at if they were fully derived minorities on an ethnicity basis, Hispanic, or on a race basis, everything but white, we coded them as minority. If they were joint or joint mixed, they generally coded as other. If they were not Hispanic and they were white, on both cases, we coded them as non-minorities. Now, there are many approaches to this type of process, but that's the one that we felt was most consistent. Taking a look at that, we did the same type of exercise. And Dennis, you can see the Busey Bank.
At the top.
At the top, 100% of minorities here received loans. All the way going down through our top 8 here, Inland Bank and Trust, a little bit lower on the minority compared to the non-minority, but each institution has the capacity to go through this process, assign its codes based on it, and come up with its scoring. Now, CIBC Bank USA, for example, on the minority scale, not as well as they did in the high minority census tracts, 82% compared to 99% as it relates to non-minorities. You can look at each institution and gain a little bit of insight as it relates to those institutions, and it's important that that insight be gained. Now let's take a look at the lowest 8 here. You can see again, First American Bank at the top with a 25% approval ratio compared to 59% non-minority. Again, this is a definite indicator of potential risk, but it doesn't solidify the risk. It only establishes the need for additional review and evaluation of the information. When we're taking a look at gaps, we know that gaps need to be understood. And almost every one of these institutions had some type of gap. That gap has to be justified. Ultimately, that's what the true fair lending analysis does. That's what an examination is trying to accomplish. The great thing now is we have a lot more resources to accomplish that from a third party. Let's take a look at one other key element as it relates to information directly from HMDA 2019. Now we're taking a look at interest rate. Of course, when we take a look at interest rate, we are interested in the averages, but it doesn't necessarily mean that the average fits for an individual case. Fair lending examinations often work against averages, but they often begin with averages. In flips, we want to give that broad analysis, and that's what we have here. So when we're taking a look at an organization, we're looking at the rate on average for our very specific scope product as it relates to minorities and non-minorities. Now here you can see, for example, that we're talking about a non-underwritten element. And you can see that Associated Bank at 4.08 compared to 3.87 is a little bit different. Can you see any of those that might kind of jump out at you, Dennis?
So if I'm understanding this correctly, the 4.09 versus 4.03 grand total, so we're pretty close to begin with, right? Not a huge difference, but there is an observable difference in interest rates for minorities versus non-minorities.
Yeah, I have a friend who always talks about the ocular trauma test. And some things always tend to jump out at you. So when you're taking a look at this data, something might jump out at you. So for example, Dennis, you see Bank of America there with its minority rate?
Yeah, looks like it's below the average by far.
Yeah, Bank of America at 3.35, significantly below the average rate at 4.09. There may be a special purpose credit program going on, or some type of incentive, or some type of action. If it is, we'd certainly applaud that. But we also know that when institutions have a gap, you want to take a look at it. You could see, for example, that Marquette Bank has nearly a 50 basis point gap between minorities and non-minorities. Is it justified? Historically, we could never know if it was justified without going into the institution, polling data. But each institution, when you take a look at their particular level of performance on this basis, you start to be able to get greater insights. You also want to match that with high minority census tracts, low minority census tracts, and that's our next slide that we're going to take a look at. So here, for example, we're looking at a very similar concept. We're looking at the average in high minority census tracts versus low minority, and they're fairly close to one another yet again. And as in the previous slide, we can see that there are some that are different, but a lot of them are relatively close. You see anybody who's pretty much right on line with it?
Yeah, it looks like JP Morgan Chase.
Yeah, look at that. Impressive.
4.11.
Right in line, only 1 basis point off on both high minority and low minority census tracts. Is that by design, or is it the fact that JP Morgan Chase dominates the market? Okay, could probably be a little bit of each, but nonetheless, this type of analytics is important that organizations start with the broad, work their way towards the narrow. Let's get into the narrow. Now we want to take a look at the more powerful insights gained from HMDA. What's happening here, to explain, to orientate you with this, is you're seeing the name of the institution and then the HMCT, LMCT, and then the grand total. Below the HMCT and the LMCT, you're seeing a number. That number represents perceived risk on the basis of loan to value and debt to income. The higher the number, the greater the risk. Now, across that, on the next, we're taking a look at the average APR as it relates to high minority census tracts and low minority census tracts. Now, we've highlighted a few, not necessarily because they represent the best or the worst, but because there's something for us to talk about. So Dennis, what are you observing with Marquette Bank?
Well, I'm noticing that their high minority census tract APR is quite a bit higher than the average, but then I'm looking across at the 13.4 and seeing that their risk is quite a bit higher, so there's a correspondence there. And same with the low minority census tract.
Yeah, and if you look at the rate, you can see that they are a little higher than the rate, but of course, we're not taking a look at all the underwriting factors. We're only looking at indicators. Those indicators become important for us, but we want to take a look, because if you remember a slide that we had before, we showed Marquette at a fairly higher rate relative to minorities and high minority census tracts. But here we gain more insights because we can see that their risk is also higher based on those factors. So that becomes a powerful aspect as it relates to rate. You could take a look at other organizations. You remember Bank of America, they score one of the lowest, if not the lowest overall, as it relates to risk. But the actual rate is higher than high minority census tracts, which are relatively significantly higher. That also underscores that there is some type of effort going on at Bank of America as it relates to risk in high minority census tracts. Again, probably associated with some type of program. Not every institution can do that, however, but it is something that an institution can take a look at. If it was by design, they now have the ability to look at it from the external perspective. That means community groups that are working with an organization can also take a look at it. They can also look at the opposite. So there's a couple here that merit some attention. BMO Harris Bank National Association shows that their rate of risk is relatively lower than the market. Not significantly lower, but when we correlate it over to the rate on the high minority census tracts, we see that the risk is lower, but the rate is higher on high minority census tracts. Yes, that's a risk factor for an organization. What it requires the organization to do is dive deeper into the numbers, and that's what an organization wants to do with this type of analysis, this type of study. It basically is a launch point for greater depth of analysis, but having this information is valuable. The last institution that we'll look at here is the Federal Savings Bank. Here you can see that they do have higher risk relative to the average at 12.8 compared to 10.4 and 11.2 compared to 8.5, both of them higher. But now when we take a look at the risk, the rate, the APR on those, 4.58 compared to 4.44 high minority census tracts to low minority census tracts. Now this has positives and potential negatives. The positive is the rate is relatively the same for high minority census tracts and low minority census tracts, and it correlates fairly well to the actual risk. But it is higher than the average. So that could be, again, a strategic decision on the part of the Federal Savings Bank, but it is something that they would want to make sure that they understand. Are they doing what they expected to do, and is it resulting in the results that they wanted? So we can see that the numbers give us powerful insights. We want to show you one more slide as it relates to the gap difference, because that too can be powerful. All right, now we've added just one other element. You can see this concept of spread. Spread represents the difference between the rate being charged for high minority census tracts and the rate being charged for low minority census tracts. A positive number means the rate is higher for high minority census tracts, and you can see the one single negative, that's Bank of America, at negative 0.24. Now, if you take a look at these factors, we could have done the same thing as it related to the gap difference on the high minority census tracts. And for our organization, that's exactly what we're doing when we get into more in-depth flips analysis. We want to take a look at the deeper information across the spectrum of the organization, but this gives you a taste of what needs to be analyzed and where you might want to start from. Now let's jump into the correlating aspect for minorities versus non-minorities on the next slide. Similar to our slide on high minority census tracts versus low minority census tracts, now we're looking at the information as it relates to minority versus non-minority, as we classified in our earlier exercise. In this particular case, we're looking at, again, differences in scores. We're looking at differences in rate. We're trying to match the two together to see if there's correlation. There are a lot of institutions that we could talk about, but let's start with Wells Fargo Bank. You could see at 8.5 compared to the average. They're significantly lower than the average, relatively speaking. One of the lowest risk from that perspective on minorities. But when you take a look at the rate, compare them to another organization such as, for example, Bank of America at 3.35. They actually have lower risk than Bank of America, but the rate is higher than Bank of America at 4.03. That type of discorrelation sometimes merits additional review on the part of an analyst. When we take a look at the non-minorities, you can see that they are relatively lower and they correlate on the non-minorities. Doesn't necessarily indicate an issue, but it does have a risk factor that an organization would be well served to analyze to determine what is the cause effect of that particular area. Take a look at First Midwest Bank. Here you can see, Dennis, that they are almost in line with the risk score of the average. 10 compared to 10.7 and 8.5 compared to 8.3. And you can see that the rate that they're charging is relatively also in line with that. That type of balance kind of goes in First Midwest Bank's favor because now you're seeing correlation between the two. It doesn't necessarily guarantee that there are not fair lending issues. You have to get into the actual comparative file analysis to truly understand that. But from a broad statistical basis, which is what we're doing at Flips, We want to make sure that we have that correlation as a starting point, and we can see that we have that in this particular institution. Let's do one last one. Associated Bank, here at the very top, 12.3 compared to 10.7. So relatively quite a bit higher risk as it relates to minorities. But look at their rate that's being charged to minorities. Almost perfectly in line, 0.1 percentage or 1 basis point difference between the grand total and their institution. So again, we've got that correlating effect, and that's what we want to see. We also see a match as it relates to risk for minorities compared to non-minorities, and rate for minorities and non-minorities. That's the minimum that an institution should be doing from an external perspective. It makes sense to do comparative analysis, and when they do that, they're really getting effective understanding, at least on a macro basis. Now, the same slide also presents the rate spread between the two. And here you can see that there are a few institutions that are in the negative. Of course, we had Bank of America, but even First American Bank is right in line with that particular effort. You can see that they're really tight and close to it, but you can also see that for First American Bank, for example, the risk associated with their minority borrowers is higher. And again, that makes a material impact as it relates to analytics. What we're trying to say when we get into analysis, Dennis, is that, of course, we've just touched the tip of the analytics. These are new, powerful insights that we never had 2 years ago or even just starting last year, but it's just the tip of the iceberg.
So what are some of the things that an institution could do beyond what you just described here?
Yeah, we're only looking at, remember, a very isolated product. Of course, it's probably the most significant product, but there are abilities to go even further in the analytics. Obviously, you can cross over into additional elements, different focus, different scope, and institutions would be well served. Our goal here at AdviseX is to give the opportunity for the large, as well as the medium and small institutions, the ability to go further with the data, to understand it, and then to present a very strong case as it relates to their performance. Given the socio-economic world that we live in, it makes a lot of sense for organizations to take the lead and not wait for a more reactionary response. That can be dangerous and problematic.
So thanks, Ken, for that dive into the data for the Chicago MSA. We'll be looking at other MSAs in future Flips presentations. This is Dennis Agel for Ken Agel. Thanks for watching.